This chart gives us the X-date crash. Now by now, you've probably heard about the looming debt ceiling debate, of course, where the US Treasury has to take on more debt to pay their existing obligations. And because this seems to come up every other year, you might be used to this. You might even be numb to this because a deal always comes through, right? Well, we now have the pending X date, which is the exact date the US Treasury will run out of money and stop paying their bills. And the markets are pricing in a good chance a deal won't be done in time. Now, I don't think anyone thinks the US will outright default. As I've said many times, no government with a money printer will ever default. But the chances of a deal coming together by this fast approaching X date are looking grim. And history shows us that even if a deal comes together in the last minute, it can crush markets and assets while others do very well. So in this video, we're going to look at these scenarios. What is the X date showing us when this all unfolds? What are the markets showing us will happen? How bad is this entire situation? And hint, it's way worse than any time in history. What could go wrong? The two giant black swan catalysts that just happened to coincidentally happen right around this X date, and how I am and how you might want to play this and be prepared. So let's go. All right, welcome back. If you're new to the channel, my name is Mark Moss and I make these videos to change the way you think about money. Because yes, almost everything you've learned is wrong. Almost everything they're showing you, telling you, of course, gaslighting is at an all-time high. And more importantly, it's so complex and complicated. What do we do about this? What does it even mean? Now, I'm going to show you the X date. I'm going to show you what this means and what's happened in history and what should most likely happen and what we're going to do about it. Now, this is a complex subject, which is why I've done several videos on this, and there will be more coming because we're looking at it from a bunch of different angles. But if you'd like to join me live, I'm going to go through about 50, 60 slides, really breaking this down, and then show you exactly what I'm doing, what assets I'm buying and selling. And I'm going to open it up for live question and answer. We're going to hang out. We're going to go through this, show you what I'm doing, answer all your questions live. You can come hang out with me for free. There's a link down below if you want to check it out. Come hang out, see what the slides show us, see what the data shows us, see what I'm doing, and let's discuss it. Hang out. There's a link down below. All right, let's jump right into this. X day or D day? Well, they just happen to be happening right about the same time, and they happen to be just about as dangerous. Of course, I'm talking about the pending X date, which is the date, the exact date that the US government, the US Treasury of the United States government runs out of money and can no longer pay its obligations. Now, I know this sounds crazy, but we have it. Now, of course, unless something happens. Now, if that happens, if the United States government could not meet its obligations, of course, that would be catastrophic, similar to D-Day. Of course, D-Day is when the beaches of Normandy, American troops stormed the beaches of Normandy. I mean, it's just an amazing feat, the bravery, the heroics of these young men to, of course, to protect our freedoms, which is why I'm so passionate about preserving them. Now, just coincidentally, the beaches of Normandy were stormed back on June 6th of 1944, right around the same time that the X date of the government running out of money is happening. Now, both of those were catastrophic dates. Both of them had massive casualties and will have massive casualties. Now, like I said, the X date is around the same time, projected to be somewhere around June 6th. We're going to take a look at that. Now, coincidentally, there's two other massive potential black swans happening around this. We're going to get to that in a second so you can understand just what's at stake here. All right, now if we keep digging in, the day is the day that the Treasury goes broke. That's the X date, the day they go broke. Now, how did this happen? I've talked about it a lot. If you're just tuning in, let me catch you up real quick. The Fed. It's all the Fed's fault. Of course, everything is. All the booms, all the busts, it's all the Fed's fault. The Fed broke everything. They said as much. We'd rather do too much. We'd rather break something. We have the tools to fix them, and so they have. The Fed has gone broke. The now U.S. government Treasury has gone broke. The banks have gone broke. Maybe some of you have gone broke. Now, this might be your chance to get it back. Let's take a look at this. Janet Yellen says June 1 is the hard deadline for raising the debt ceiling. Meaning, if we don't take on more debt, we're going to die. Meaning, if we can't get another credit card, how are we going to pay our bills? The insanity. And here's what the Fed did to break everything. Of course, they went on this. First, they went on a massive easing cycle. They lowered rates down to zero. Well, they kept them here for zero forever. They tried to raise them up in 2019. and that's when the market broke. Of course, the market broke before the pandemic. It started breaking right here. The pandemic happened here, and it started coming down, and they held it for way too low for way too long, put way too much money into the system, and then went on the fastest rate hiking cycle in history, which of course, like I said, it broke everything, including the Fed itself. Let's take a look at this. The Fed is a bank. They have assets, they have income, they have liabilities. Now, just like you and I, if their liabilities, their expenses exceed their income, they lose money. And what we can see going back to 2011, this is the amount of money, the profit that the Federal Reserve, the bank, the Federal Reserve has made. And what they do with that profit is they give it to the government. And so we can see since 2011, that profit has remained pretty much flat. Even here in 2020, the profit stayed flat. And so the Fed gives money to the government, US Treasury, all the time. But something happened. The Fed made themselves broke. And you can see it right here. It has plunged off of a cliff. As a matter of fact, it doesn't even fit on the chart anymore. Now, to put that into numbers, that's over $60 billion in losses that should be going to the Treasury, but it's not. And so the Treasury's income has gone down at the same time as their expenses have gone up because, yes, their debt. Now, what we can see is not only did the Fed go on the fastest rate hiking cycle in history, I showed you that, they've also been reducing the size of their balance sheet. So this is the amount of debt that's been on the Fed's balance sheet, and they started to tighten that, meaning getting rid of that debt. Of course, they caused a banking crisis, which caused them to reverse course, put some back on their books, but of course now they've been taking that back off of again. This is the ebb and flow that you're seeing in the market. I wanted to show you this chart because I want to show you this chart as well. This chart right here, let's look at these together. So this chart right here is how much money the government has. This is the Treasury balance, the TGA account. And you can see right here is $1.8 trillion, 1.8 trillion, and it's just been coming down slowly ever since to where there's about 50 billion left, from 1.8 trillion to 50 billion. Now, the reason why I wanted to show you this is because as the Fed was tightening, as the Fed was getting rid of money, reducing their balance sheet, the Treasury was making up for it. So the Fed was taking the money away and the Treasury was putting the money back into the market. But you can see that the Treasury is now out of money. So what happens when the Treasury's out of money and the Fed continues to tighten? Well, we're going to come back to that in a minute. So going back to, thinking about it in terms of you and I, our businesses, the credit cards are maxed out. What does that mean? Like if you were broke and you were living on your credit cards and that one credit card's broke, it maxed out, and you get another credit card, they max it out, and now you're applying for new credit cards. That's basically where the government is, the US Treasury. They must take on new debt to continue to pay for the old debt. Sort of like a Ponzi scheme. Actually, exactly like a Ponzi scheme. Now, I want to show you how fast this is getting out of control. So this is a statement directly from the US Treasury. This is a screenshot off of their website. This was dated October 31st. And the reason why I want to show you this is to show you how out of control things are. They have no idea what's going on. So this is from October. What we can see here is it says during the October to December 2022 quarter, so through that quarter, end of quarter last year, the Treasury expects to borrow $550 billion. So they were already in debt, even though things were much better. They had to borrow $550. However, the borrowing estimate is $150 billion higher than they had announced just in August before that. And the reason why I'm showing you this is, so in August they announced what they were going to borrow, but then it turned out they were way wrong and they had to borrow way more than they had even projected. During the January to March 2023 quarter, so now they're looking into the future because it's written in October last year. So they say the first quarter of 2023, the Treasury expects to borrow $578 billion. So they missed this forecast and now they're making another forecast. Well, let's see what they said around that date. So they projected to borrow about $500 billion in the first quarter of 2023, but as you've seen me talk in several other videos, it ended up being almost $1 trillion. And that's about double. So you can see how fast this is running away. The Treasury can't even predict where they'll be the next month or the next quarter. As a matter of fact, they're so far off, the amount of money they've had to borrow has been double that. Now we can see here, Janet Yellen, another Treasury press release saying right here, talking to the congressional leadership saying, please, sir, my family. You can see right here, in my May 15th letter, I noted that our best estimate was that Treasury would be unable to continue to satisfy all the government obligations by early June. Her best estimate. Well, her best estimates have been horrible. It says it's impossible to predict with certainty the exact date when Treasury will be unable to pay all the government bills. However, it's highly likely that the Treasury will no longer be able to satisfy as early as June 1st. Now, they've been wrong about everything. I don't give her a lot of credit for getting this right. So it could be coming much faster. And that's sort of what the markets are telling us. So what we can see, because both sides are holding firm right now. President Biden says, I'm not bargaining. Republicans, we're not bargaining. So we're going to see what's going to happen. But I'm actually going to show you what potential outcomes we have, but take a look at this. So the last time we got this heated was 2011. 2013 was pretty bad as well, but 2011 was the closest we ever got to an actual default. What you're looking at right here is a chart. It's the 1 month, the short-term dated treasuries, looking at the effective federal funds rate. Now what we can see, this red box right here is in 2011. And what you can see is the spread between the 1 month and the effective funds rate stayed in a pretty tight band. As a matter of fact, it wasn't very abnormal at all. Now that was the worst it's ever been. This is the closest we've ever been to a default. Now compare it to this red box. Look at that. Look how far down we are. That is the markets pricing in a default. Look at that. That's the difference. So that's what they're saying. Now, the one question I want to ask you before we move on, and I show you what could potentially happen, the two other big black swans that are there, what we should have done in 2011 with our money and what we could do now. Before I do that, I just want to ask you this question. Could you think of anybody in the world, any parties, any factions, any globalists, any governments who might want to see the United States default on their debt? China, Russia, ECB, Klaus Schwab. Do any of those people have ties to the Biden administration? Just think about that for a minute. We'll come back to that. I want you to think about this through an adversarial lens. All right, now, what could possibly go wrong with all this? Well, let's see. There could be no deal. The Biden administration could hold strong, the Republicans could hold strong, and there could be no deal. Now, what would happen if that was the case? Now, what we're already seeing is the Democrats, the Biden administration, trying to figure out what they can do. Can they change the Constitution? Can they go to another vote? Can they print $1 trillion coin? We've talked about some of this before. But now, this appears to be their backup plan. And it says Democrats launch a discharge petition aiming to force a debt ceiling vote. So basically what they want to do is they want to just get the Republicans out of the way, and they want to force a vote without them. So this is kind of what their plan is right now. The problem is, per the article, is that they're going to have to get a lot of Republicans to go along with it, which doesn't look really good. They're going to need to get at least 5 GOP representatives to sign on with the Democrats. So probably not a super good chance. But even if they did, the earliest a bill can be brought to the House under this procedure is by June 8th. But you remember Janet Yellen said we could run out by June 1st. They can't even get this bill until June 8th. If Democrats gather all the signatures in a single day, which isn't going to happen, but even if they did, the earliest a bill could come to the House would be June 8th. The Senate would then have to pass it too. So then it has to get there and it has to be passed. What we can see here is the House in session schedule. So it's not going to happen. May 25th is the final day the House is in session until June 5th. They're not even going to be there. That means the X date could be moved up as early as the 25th. Things are coming to a head fast. Now, what would happen if that happened? Well, all kinds of things would happen. And for example, markets would probably plummet. Of course, borrowing costs would go up. And you can see the other betting market, I've talked about this one before, the credit default swap market is pricing in a default. This is people buying insurance against a default. There was no chance of a default before. No one's really buying insurance, but look at the price of that insurance today. Now, what we can see going back in history is the last time we had this situation, like I said, 2011, you can see that the S&P 500 sold off by 17% going into that situation. Now, of course, we are in the middle of one of the longest bull runs in history, so of course it recovered, but Did you want to watch your portfolio draw down by 20%? Now that's the average of the S&P 500. Lots of names went down by way more, and you wouldn't want to be holding those names. All right, now if that's not bad enough, there's two other massive potential problems. Black swans, as we call them. Of course, since we can kind of see them, they wouldn't be black swans. Maybe they're more like gray swans. What am I talking about? Well, there's two. So first of all, there's the LIBOR to SOFR transition. So if you've ever got a loan, like a house loan, you probably have heard of LIBOR. It's the London Interbank Exchange Rate. So in London, it's a group of banks that set the interest rate. The amount you pay for your home, etc., has been being set in London. Of course, Jamie Dimon, Jay Powell at the New York Fed said, wait a minute, we don't want to allow London to set the price of our money, so we're going to get off of LIBOR, that we've been on forever, and we're going to move everything over to SOFR, which is a secured overnight rate. All right, it's one that we can control. Now, we're moving upwards of about a quadrillion, I don't even know what that number is, a quadrillion dollars worth of assets is being re-indexed from the LIBOR to the SOFR. And of course, that's happening on June 30th. Right when this is happening, we're going to move a quadrillion dollars of assets over and re-index them. You can see right here, this is per the BIS, the Bank of International Settlements website. The notional value of outstanding over-the-counter derivatives rose to $632 trillion at the end of June 2022. It's a lot of assets. What could possibly go wrong? Now we can also see that FedNow is also kicking in July 1st. When the FedNow banking system goes online, the potentially precursor to a CBDC, where banks are able to transfer money. Now, what if something were to happen where it doesn't work, there's a bug, the banks can't transfer money? This software rate is set by the overnight exchange rate. So if the banks can't move money, if a bug happens and they can't move money, what happens to the rate on that overnight rate? If you answered up, you would be right. So now we have trillions and trillions, hundreds of trillions of dollars moving to this rate that could easily go up off of a little tiny bug. You see, we are in very dangerous territory. Lots of potential gray swans could happen. Now, what would happen if we get a deal? Because it could still be bad if we get a deal, like in 2011. So for example, if we get a deal, there's going to be a sudden drain on liquidity. Why? Well, because the Treasury is going to have to refill its account. As I showed you, the Treasury's broke. They need to get more money. Now, when we look back in history, when this happened before, what happened? So here we are in 2019. Now, if you've been watching me or any other people like me, very similar, then you probably already know. The market started crashing in September of 2019. That's when the yield curve became inverted. That's when the reverse repo window seized up overnight, September of 2019, before the March 2020 crash. So what happened in September of 2019? What caused that? Well, here we are. This is the Treasury account. And what we can see is right here is where they started to refill their account. They were broke, just like they are now, because the same problem. The Fed was on a tightening program. So the Treasury was refilling their account. At the same time, the Fed was draining liquidity, and that caused the banking system to lock up. Now, if that happens again at the same time as we moved all those quadrillions of dollars over to the software market, things could be very, very bad. Now, this is just if history repeats. Of course, it doesn't repeat, but it certainly rhymes. Of course, we have a sell-off in the markets. I already showed you that. The S&P 500 sold off 17%. And we always want to look back to history to kind of get an idea of what could happen. We can also see what types of assets did good and bad. So this is in 2011. We can see that long-dated treasuries went up by 30%. Of course they did, because the borrowing costs went up. So treasuries were a good place to be. We also saw gold went up by 21%. Of course, gold is a chaos hedge. It's how you want to protect yourself when the banking system crumbles around you. The 10-year treasury, 8%. TIPS went up by 7%. What did bad? International stocks did horrible. Emerging markets did horrible. US large caps, as I said, 17%. US small caps, almost 25%. So what we would consider risk-on assets, this would be stocks, emerging markets, went down. Risk-off assets, long-dated treasuries, gold, did very, very well. So we might say, well, that's what happened in history. What would happen now? Well, probably similar thing. As a matter of fact, per this survey that Bloomberg did, it said we asked, what will you buy if the US hits the debt ceiling? As a matter of fact, 51% said gold, 15% said treasuries, and Bitcoin was the third listed thing that they would buy. Bitcoin is moving to this risk-off asset. So gold, treasuries, and Bitcoin in today's day and age, according to this analyst survey. Now, what do you think? Do you think history repeats or does it rhyme? But as I just showed you, whether this debt ceiling, whether this X date gets resolved favorably or not, it's probably going to be really bad. And I would want to be prepared. I am prepared. I'm preparing my portfolio, and you should be preparing yours. So let me know what you're doing about that down below. Of course, like I said, I'm having a 1-hour presentation. I got about 30, 40 slides we're going to look through. I'm going to talk about it, show you what I'm doing, and I'm going to answer all your questions live. There's a link down below. Come hang out, get all your questions answered. Sign up. It's free. Just come hang out. But that's what I got. As always, give me a thumbs up if you like it. If you don't, you can give me a thumbs down. That's okay. But at least leave me a comment and tell me why. Of course, hit that subscribe button if you're not already. And that's what I got. To your success. I'm out.